Hi, my name is Rupesh Patel. I manage Nippon India Tax Saver Fund. Nippon India Tax Saver Fund is a market cap agnostic and sector agnostic diversified fund. Here, the approach is to construct a diversified portfolio on bottom-up basis. However, as far as Nippon India Tax Saver Fund is concerned, I would like to emphasize that the exposure to large cap stocks at any point in time would remain at least 50%, and remaining 50% can be spread across large caps, mid caps, or small caps, depending upon the market opportunity. We believe this gives us a good balance to play across market capitalization, and in perspective also, this is a good enough combination to play across market capitalization. Now the question is, what do we buy in our portfolio? So the general idea while picking up stocks for the fund is to look for businesses that have potential to grow their earnings at reasonably high rate. We also look at opportunities where there is potential to surprise on earnings growth. Fund would also tactically consider opportunities where, because of near-term industry-specific headwinds or company-specific developments, prices have corrected, but we believe that the price offers an attractive risk-reward opportunity. These would be very opportunistic exposures. If I have to give you an example, then current exposure to some of the commodity stocks in the fund would be an example of such tactical exposure. So whilst constructing a portfolio in this environment, there are challenges from reversing liquidity, high valuations, and potential margin headwinds. However, the pockets for opportunities in India can come from pickup in private sector capex on account of delivered balance sheets, on account of support from government, from schemes like PLI, or on account of opportunities arising from China Plus One outsourcing strategies. Government's continued push to up public sector capex is another tailwind which is possible, which can possibly play out in the next couple of quarters. And we are also positive on demand coming from household sector as we recovered from recent COVID wave. Accordingly, we are spreading our bets on companies in sectors like infrastructure, cement, real estate, auto ancillaries, banking and financial services, and consumer discretionary plays like multiplex, retail, alcoholic beverages. As we speak, our biggest overweight is in banking and financial services. As we believe that these banks, both public as well as private sector banks, I would say some of the public sector banks, we believe that these banks are well capitalized. The large NPAs from previous cycle are well recognized and provided for, resulting in lower credit costs as we move ahead. Retail asset quality has held up pretty well during COVID times. Strong liability franchisee, I think it would be a strength in rising interest rate scenario. And almost all of them are investing behind technology to remain competitive. Although as of now, credit growth is a bit subdued. However, we believe with overall uptick in the economy, even credit growth should pick up. And finally, I believe that the valuations of these banks are not very expensive in the context of overall market. We are also positive on urban discretionary consumption. We believe there is significant pent-up demand as the balance sheets of top 10-15% households in the country has improved and they have capacity to spend. We believe growth in per capita leading to increased penetration levels across categories and trends of premiumization are structural in nature and will play out over longer periods of time. On any meaningful correction in the market, this is definitely a segment where we are looking at increasing our exposure. Before I conclude my remarks, I would also like to share my views on ELSS category in general. Many investors tend to look at this category only as an option to save taxes. However, considering the fact that there is no restriction on how much you can invest in an ELSS fund and for how long you can remain invested beyond mandatory 3-year lock-in, I think it's a good vehicle to accumulate wealth and it gives you a good exposure to a well-diversified equity portfolio. Hence, would urge investors to look at it as a vehicle to invest in equities and do not restrict themselves only to the extent of investments required for saving taxes. Well, these are some of my thoughts around ELSS category and in particular Nippon India Tax Saver Fund. Would be happy to connect with you again. Thank you so much for your attention.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.